Charlie Munger has just increased his stake in Alibaba stock by over 83%. So is Alibaba stock a buy right now? Well, in this video, you guys are going to find out. We're going to dive into the headlines. We're going to dive into the latest SEC filing, which shows Charlie Munger has increased his stake in the Chinese tech giant Alibaba, which is known as the Amazon of China. Then I'm going to dive into my valuation model for Alibaba stock and give you guys my valuation and buy point for this company. And then we're also going to dive into the risks with investing into Chinese stocks. So before we hop right in, guys, if you're not subscribed yet and you do want to join our investing family, feel free by hitting that subscribe button and turning that notification bell on. And remember, if you want to check out our VIP group, that is the first or second link in the description below. With that being said, let's dive in. Charlie Munger's daily journal swooped on Alibaba's tumbling stock last quarter and boosted its stake by 83%. Now, this information is from the latest filing, the 13F filing by the SEC. So every investment manager with over $100 million of assets under management must file every quarter with the SEC to say which stocks they've been buying and selling. And this is great news for us investors because we can check out the SEC filings, as I can show you right here, and we can actually view which stocks Charlie Munger has been buying. So hopping into Alibaba's share price, we can see why Charlie Munger was buying this stock. So Charlie Munger's a classic value investor. He's a deep value investor, really. And if we hop in here, we can see Alibaba stock over time has, of course, had a monstrous bull run. It was up 195% from 2016 to 2020, so great returns. However, then there was a major decline by 47%. Now, full disclosure, guys, during this decline, I was buying shares of Alibaba stock, and I did alert everybody in our VIP group and maybe even on this channel also. So if you do want those alerts next time, check out that second link in the description below for our VIP group. Okay, so why did Alibaba stock crash? Well, this was due to a few reasons. One of the main ones being Chinese government's crackdown on tech companies. So the Chinese government is a communist government. They don't really have a traditional democratic system like over here in the West. And they saw these tech giants as a threat to their own power. And also the data that these companies collect is also a threat to their own power. So they started to crack down on many of these tech companies. And this even resulted in Jack Ma having a bit of an issue with the government and going missing. So Jack Ma is the founder of Alibaba and then obviously appeared again. But yeah, there's a lot of stuff that's been going on with Chinese tech companies, and that is why the stock has crashed. Okay, so what's Alibaba's business model? Well, hopping in right here, guys, I have done a full valuation on Alibaba in the past, but here's just a brief overview. So they own retail marketplaces such as Taobao.com, Tmall.com, AliExpress, Alibaba.com. So many of these work with small businesses in China to export to many other parts of the world. So if you ever want to buy anything in bulk from China, you can do that through Alibaba. But Alibaba also has services such as Alibaba Cloud, which is a cloud services provider, the number one leader in China, which is very similar to Amazon Web Services over here in the West. So there's many elements to this company. It's a gigantic beast of a company, and it's growing at tremendous rates, over 30 to 40% each and every year on their revenues. Okay, so is Alibaba stock a buy, and what is my valuation and buy points? Well, hopping into here, guys, this is my advanced valuation model created in partnership with a professor of finance from New York University. And hopping into the revenues, we can see revenues here, $111 billion. I've converted all the currencies over from Chinese yuan to US dollars to make things easier for you guys. I've plugged in all the numbers here, so I won't bore you with the details there, guys. And I've been very conservative with the growth because it is a massive company, and I've predicted a 35% growth rate on the revenue rather than 40 and 45% of which this company has grown at previously. And I predicted a compound annual growth rate for the next 2 to 5 years of 25%, which is still extremely good. Pre-tax operating margins are predicted 18%, so they're currently around 16.8%. So I'm predicting them to increase a little bit, around 1.2% over the next 3 years. So that's also a conservative estimate. And hopping into my valuation for the stock, I get a fair value for the stock of $190 per share, which is a conservative valuation. Now the stock, guys, was trading when I did this valuation $155 per share. It's now at around 160, but it's still approximately 19 to 20% undervalued. And Charlie Munger likes to invest on the same principles as Warren Buffett, and that's to value a company and invest below that fair value, ideally 20 to 25%, giving himself a margin of safety. And this seems to be exactly what Charlie Munger's done and why he's increased his stake by over 83%. So I know you guys are probably thinking right now, okay, Ben, that sounds really simple. So we can just put all our money into Alibaba stock. It's undervalued and then it'll rebound over time and we can just follow Charlie Munger. Well, that is one theory, but before you go and do that, guys, firstly, this is not financial advice. Secondly, we do need to take into account the risks associated with investing into Chinese companies because there are some major risks. So I personally would limit Chinese stocks in your own personal portfolio. I wouldn't say don't invest into them because of China's growing middle class, their growing population. It is a great place to invest, but there are some major risks. So the first major risk is the Chinese tech crackdown. That is the first one we need to be aware of. This will cause a lot of volatility in Chinese stocks, lots of up and down swings. So really, you need to hold on to the stocks tight if you're investing during these periods. The second major risk is the way these Chinese companies are set up. So when you invest into a Chinese company from the West, let's say from the US, from the UK, Europe, you invest into what's called an ADR. So this stands for an American Depository Receipt. And basically these Chinese companies are actually registered offshore from China and places such as the Cayman Islands. So you're effectively investing into a shell company, and that shell company has a contract with the mainland Chinese company. And really that's all it's based upon. So that's a contract with rights to the company's revenues, profits, etc. But that's what you as a retail investor are investing into. And to me, that is a major risk, maybe even above the Chinese tech crackdown. But that's today's video, guys. I hope you did find that valuable. If you did, feel free to give this video a big thumbs up. It helps out tremendously with the channel. If you do want to access our thriving VIP membership group and get access in real time to exactly which stocks I'm personally buying and selling in my entire investment portfolio, check out that second link in the description below. And if you want to learn how to become a great fundamental value investor, then feel free to check out that first link for our ultimate investing strategy course. And you'll learn everything about how to be a great value investor, how to be a great growth investor. And you'll also get access to my stock research platform with over 56 different stocks of which I've valued and analyzed and given my buy points for. And all those spreadsheets you can download and play around with yourself. So that being said, guys, thank you so much for watching. I hope you all have an incredible day, and I'll see you in my next video. Invest safe.